In the global financial markets, it is often the smallest shift in tone from a major central bank that shakes the entire world. We are told to watch the Federal Reserve. We are told to watch the White House. But while the world was fixated on American politics, the real earthquake began on the other side of the planet. This week, the tremor came from Tokyo. For 3 straight decades, the global financial system has rested upon a foundation that few average citizens noticed, but every major hedge fund, bank, and government relied upon. Japan has functioned as the world's monetary anchor. By keeping its interest rates at zero, and sometimes below zero, Japan acted as a fountain of cheap liquidity for the rest of the world. It was the silent giant that subsidized American mortgages, funded Wall Street speculation, and kept the cost of global government debt artificially low. But now, the silent giant has pulled the trigger. The Bank of Japan has signaled a historic pivot. They are ending the era of free money. To the uneducated observer, a small rise in Japanese interest rates sounds like technical trivia. But to the financial historian, it sounds like the snapping of a cable that holds up a suspension bridge. This documentary is the full story of the Great Unwinding. We will expose the invisible mechanism known as the yen carry trade, explain why Japan's domestic recovery spells a disaster for U.S. debt markets, and reveal why the financial history of the next decade will be written not in dollars, but in the reaction to the rising yen. The era of the silent giant. To understand the magnitude of this shift, we must first understand the anomaly of the last 30 years. Japan has not been a normal economy. Since the bursting of its massive asset bubble in the early 1990s, Japan has lived through what economists call the lost decades. While the rest of the world dealt with cycles of boom and bust, Japan dealt with a different monster. Deflation. Prices kept falling. Wages stagnated. The population aged. To keep the economy from freezing to death, the Bank of Japan became the pioneer of unconventional monetary policy. They invented zero interest rate policy in 1999. They invented quantitative easing in 2001. They effectively printed endless amounts of yen to try and spark inflation. And when that wasn't enough, they introduced yield curve control, promising to buy unlimited amounts of government bonds to keep interest rates pinned near zero. This created a unique distortion in the global economy. Money in Japan was free, literally free. And because money flows like water to wherever it can find a return, that free money didn't stay in Japan. It flooded out. Japanese investors, pension funds, and banks, desperate for any kind of return, took their cheap yen and sent it overseas. They bought Australian mining stocks. They bought Brazilian bonds. But most of all, they bought United States debt. Japan became the largest foreign holder of U.S. Treasury bonds, accumulating over $1.1 trillion in effect. Japanese savings were funding American spending. The Japanese housewife, saving for retirement, was indirectly financing the U.S. military, the U.S. housing market, and the U.S. government deficit. This arrangement worked beautifully for the West. It kept borrowing costs down. It kept liquidity high. It allowed the U.S. to run massive deficits without immediate consequences. But it all depended on one thing: Japan staying stuck in deflation. The trigger, but nothing in economic history lasts forever. The conditions that kept Japan frozen have thawed. For the first time in a generation, Japan is seeing sustained inflation. Core inflation has stayed above the Bank of Japan's 2% target for over 2 years. But it is not just prices rising, it is wages. In the spring wage negotiations of 2024, Japanese unions secured a wage hike of over 5%, the biggest jump in 33 years. The deflationary mindset is breaking. A new generation of Japanese workers and companies are starting to expect prices and wages to rise. This sounds like good news for Japan, and in many ways it is. But for the global financial system, it is a nightmare. Why? Because the Bank of Japan can no longer justify keeping interest rates at zero. If they keep rates at zero while inflation rises, the yen will collapse, destroying the purchasing power of their own people. To save the yen and stabilize the economy, they must raise rates. And that is exactly what they are doing. The Bank of Japan, Governor Kazuo Ueda, has signaled that they are reviewing the pros and cons of lifting rates. The market reaction was instant. Japanese government bond yields surged to levels not seen since 2008. The trigger has been pulled. The era of free yen is over, and the consequences are about to wash over the world like a tsunami. The death of the carry trade. The mechanism that transmits this shock to your wallet is called the yen carry trade. This has been the most profitable, reliable trade in financial history for the last 20 years. Here is how it works. Imagine you are a global investor. You can borrow money in Japan for basically 0% interest. You take that borrowed yen, convert it into US dollars, and buy a US Treasury bond paying 4% or 5%. You are making free money. You are pocketing the difference between the cost of borrowing, 0, and the return on investment, 5%. Now, multiply that by trillions. Hedge funds did this, banks did this, even corporations did this. They used cheap yen to fund speculation in tech stocks, and crypto, and real estate, and in emerging markets. The yen was the funding currency for the global everything bubble. But now look at the math. If the Bank of Japan raises interest rates, the cost of borrowing that yen goes up. At the same time, if the yen strengthens against the dollar, which happens when Japanese rates rise, the loan becomes more expensive to pay back. Suddenly, the free money trade isn't free anymore. It's losing money. This forces investors to unwind the trade. They have to sell the U.S. assets, stocks, bonds, crypto, to buy back the yen to pay off their loans. This creates a massive selling pressure on global markets. We saw a preview of this in early August of this year. When the Bank of Japan hinted at a rate hike, global markets convulsed. The Nikkei crashed. U.S. tech stocks plummeted. Bitcoin dropped. It was a liquidity shock. The water was being drained from the pool. But that was just a tremor. The real quake comes when the structural unwind begins. Billions, perhaps trillions of dollars worth of capital that was parked in Western markets will need to be repatriated to Japan. The U.S. debt nightmare. This brings us to the most terrifying aspect of this shift, the United States Treasury market. The U.S. government is currently running a deficit of nearly $2 trillion a year. It needs to sell a massive amount of bonds just to keep the lights on and pay the interest on its $36 trillion national debt. For decades, the U.S. didn't have to worry about finding buyers. Japan was always there. Japan needed somewhere to put its excess savings, and U.S. treasuries were the automatic choice. But now, Japanese yields are rising. The 10-year JGB yield is creeping up toward 1%, 1.5%, and potentially higher. For a Japanese institutional investor, like a pension fund or an insurance company, the calculation is changing. Why take the risk of sending money to America, dealing with currency fluctuations and hedging costs, when you can finally get a decent, safe return right here at home in Japan? Data already shows this shift. Japanese investors have been selling foreign bonds and buying domestic Japanese bonds. They are bringing the money home. If Japan stops buying U.S. debt, who fills the gap? The U.S. Treasury will have to offer higher and higher interest rates to attract other buyers. This pushes U.S. yields up, and when U.S. Treasury yields rise, mortgage rates in America rise, credit card rates rise, auto loan rates rise, the cost of capital for every American business rises. Japan's recovery effectively exports inflation and higher interest rates to the United States. The U.S. government, already paying over $1 trillion a year in interest expenses, will face an even steeper bill. This is the mathematical inevitability of a sovereign debt crisis. The butterfly effect on your portfolio. You might be wondering, I don't own Japanese bonds, so why does this matter to me? It matters because the financial world is a single, interconnected ecosystem. When the cost of money rises in the country that supplies the world's credit, asset prices everywhere must adjust. Tech stocks and crypto. These are long-duration assets. They thrive on liquidity. When the yen carry trade unwinds, liquidity dries up. The correlation between the yen and the Nasdaq is not a coincidence. As the yen strengthens, high-risk assets often sell off. Real estate. Commercial real estate in the U.S. is already teetering on the edge. It relies on cheap refinancing. If Japanese banks, who are huge lenders in global real estate markets, pull back their capital to invest domestically, we could see a credit crunch in the property sector. Emerging markets. Countries like Brazil or Turkey often suffer when global liquidity tightens. The capital that flowed into them searching for yield will flow back to the safety of a yielding Japanese bond. The geopolitical shift. There's a deeper layer to this. Japan's move is not just economic. It aligns with a broader geopolitical fragmentation. We are seeing the end of the unified dollar-based financial system. China is dumping U.S. treasuries. Russia is locked out. And now Japan, America's staunchest financial ally, is being forced by economic reality to step back. This leaves the U.S. Federal Reserve in a lonely position. If foreign buyers retreat, the Fed might eventually be forced to step in and be the buyer of last resort, printing money to buy the government's debt. That leads to the next phase of currency devaluation. Japan's pivot forces the U.S. to face its own fiscal reality. The exorbitant privilege of borrowing cheaply from the rest of the world is fading. The trigger has been pulled. The bullet is in slow motion, but it has left the chamber. Japan is normalizing. After 30 years of being the global anomaly, it is becoming a normal economy with normal interest rates. But the world is not structured for a normal Japan. The world is leveraged to the hilt, assuming that Japan will always provide cheap money. As this shift accelerates, we will see volatility. We will see sudden air pockets in the stock market where buyers disappear. We will see confusion from pundits who don't understand why good earnings reports are met with selling. The reason is liquidity. The tide is going out. For you, the individual investor or observer, the lesson is clear. The era of passive, easy gains driven by global money printing is pausing. We're entering a period where capital actually has a cost. In this new environment, cash flow matters more than speculation. Real assets matter more than financial engineering, and understanding the history of global money flows is the only map you have in a territory that is changing every day. Japan has signaled the end of an era. The financial history of the next decade began this week in Tokyo. The question is not if the impact will hit, but how prepared you are when it does. This is the Financial Coin Historian. History doesn't repeat, but it rhymes, and right now the rhyme is signaling a massive shift in the global order.